Good, either morning, afternoon, or evening for traders out there. My name is Greg Michalowski. I am the Vice President of Market Strategy for FXDD, and today I'm going to speak to you about trading non-trending markets. First of all, let me thank the people at the FX Street for allowing me this opportunity to speak to you all. I appreciate the effort that they do, not only for us as presenters, we are a broker, but also for you people out there who want to learn a little bit more about foreign exchange and about foreign exchange trading. I'm all about education. I'm all about sharing my wisdom, as someone said before the show started, about what I've learned in the markets over the last 25 years or so. And certainly in my position at FXDD, I get to see a lot of what retail foreign exchange traders do right and do wrong. At the end of this presentation, if you do want a copy of the PowerPoint, you can just send me an email at greg@fxdd.com, and I will be happy to send you this. And I also assume that the good people at FX Street will have the rebroadcast of this available to everyone to listen to as well. So hopefully those things that you do not get will be able to pick up on the rebroadcast, and those people who may not be able to participate here in the initial broadcast will be able to enjoy it in its entirety. So thanks FX Street again for doing that. I'm going to start off with a quote, and this quote, or not a quote, it's a law. Give you a little hint, but the law says an object at rest will remain at rest unless acted by an unbalanced force. An object in motion continues in motion unless acted on by an unbalanced force. And anyone out there in our audience know who said that? Whose law is this? Newton. That's right, Harley. Good job. This is Newton's law of inertia, and Sir Isaac Newton was the author of that. And it's probably the only thing that I remember from high school physics, but it has some meaning to me in the financial markets. And by that I mean that if I just change a few words here, I could say something like this: a market at rest will remain at rest unless acted by an unbalanced force. And market, what's N? That should be a market in motion continues in motion unless acted upon by an unbalanced force. And that was not said by Sir Isaac Newton, but that's my law of non-trending and trending markets. And I'm not a sir, I'm just a mister. So it's Mr. Greg Michalowski who was one who changed that around, and I thank Mr. Newton for giving me the idea about this. But the markets do trend, and they do non-trend. And for those people who have been involved in the markets over the last month or so, what we've seen is actually a market that has non-trended. And if you look at this graph right here of the euro versus U.S. dollar, I outlined I ask you, what does this say to you? What does this chart say to you? This is something very important to me, but for you, what does seeing something like this say to you? And then I'll put up another chart, and I'll look at the sterling versus U.S. dollar. And this is a daily chart, and this is this is also, what does this period say to you? And for me, it says a lot. It says, and Donnie gave me the right answer. It says no trend. It says no trend. And in fact, if I were to look, and it comes in about 344 pips. 344 pips. And this is a history, and I picked 21 because it kind of worked, but also 21 is months of trading, really 21, 22, something like that. If you have 30 days in a month, you take out 8 days for weekends, you got 22, but 21's, hey, it's Fibonacci number, how about that? So, is it a Fibonacci? No, but anyway, it is the range over the last 21 days, or around a month of trading, is 344 pips, and you can see on a historical basis, it hasn't been since this day, back in December 3rd to be exact, of 2009, that the range for the euro versus US dollar was last at 344 pips. So this period that you saw, that yellow section in the chart, is historic. It's historic over the last couple of years as being the most narrow range, tied for the most narrow range over the last 2 years, 344 pips. That means a lot to me. That means a lot to you. I don't know what it means to you, but it means a lot to me. Now let's look at the sterling versus US dollar and look at the same 21-day period. And the 21-day high to low trading range is near 2-year lows. Now this one is not at the lowest level in 2 years. This period right here, going back to May of this year actually, had a range of 397 pips. But on a historical basis, how does that this 416 pip range over the last month of trading in the sterling versus US dollar rank in comparison to history, to recent history of the last 2 years? And I could probably go back further, but I didn't want to clutter up the charts too much here. And I think 2 years is certainly a good enough measure of what the range has been. So clearly, what we're seeing here, folks, is that the market is in that non-trending range. It needs to be acted on by an outside force to get it going. And right now, it's an object at rest, and an object at rest will stay at rest until acted on by an unbalanced force that will push the market one way or the other. So the average, I'm big into these numbers, and so what I took was the average 21-day running range for the euro dollar in 2010, just to give you an idea, is 713 pips. So we saw that the 21-day range is 344 pips. That's what I told you. It's 344 pips over the last 21 days. The average running range for 21 days in the euro dollar this year is 713 pips. 713 pips. That says a lot to me, folks. Does it say a lot to you? It should. Now, the average 21-day running range for the sterling versus US dollar in 2010 is 784 pips. What was it that we looked at? 416 pips. The average is 784 pips over a 21-day period. High-low trading range. Interesting. It says that we have some potential energy here, some potential possibility of a move, perhaps, in either of these currency pairs. So let's assume that the 21-day range will be extended. Why would you say that? Well, I'll tell you why, and it's because traders out there, whether it's you, whether it's the institutional traders, whether it's a hedge fund, whether it's a whatever, anyone who's in the foreign exchange market are paid to make money. And you, as a retail trader, should have a mission statement. I've told about this mission statement before in some of my commentaries, and that mission statement should be to make the most amount of money with the least amount of risk. Make the most amount of money with the least amount of risk. So how are you going to go about doing that? How are you going to go about making the most amount of money with the least amount of risk? Well, the most amount of money is made and lost in the market trading trends. And so if we have this group of traders out there and they're paid to make money, I've come to the conclusion that if the market were to just sit here in the most narrow trading range over 2-year time period because nothing is going on or the market's going to, that guess what? Those traders out there who have the wherewithal to push the market one way or the other will not make a lot of money. And so guess what? They're probably not going to get paid a lot of money in what they try to do. And you as retail traders as well rely on those kind of people to move the market one way or the other. And through time and history, what we've seen is that traders get impatient. Traders out there who have the wherewithal to push the market one way or the other will eventually push the market one way or the other. It's just part of their blood, it's part of their makeup, and you as a retail trader have to try to follow them. You have to try to follow them, and if you can follow them, then you can take advantage of what they are trying to do and what you are trying to do to make the most amount of money with the least amount of risk. And so what I conclude from all this is that the Forex market, if the Forex market is not trending, guess what? I'm going to look for a trend. And if it doesn't trend, then I'm going to be in the same boat as all the other traders, not making any money, and that's going to make me angry. And I think eventually it's going to trend. So one of my theorems, remember theorems from geometry, is the Pythagorean theorem was the one that I remember, and that was a squared plus b squared equals c squared, and it talked about triangles and stuff like that. I called that a theorem. But one of my theorems in trading is this: non-trending markets will transition into trending markets. It's a truism. It will eventually happen. You just have to be prepared for it. And if you can anticipate a trend, guess what? You're more inclined to stay on that trend. And if you can stay on that trend, guess what? You're going to make the most amount of money, because where is the most amount of money made? It's made in trending markets. Trends are directional. Trends are fast. Trends are fun when you're on them. Trends are horrible when you're not on them and you're trading against the trend. So you as a trader only have one choice: to trade the trends. To trade the trends when they happen. So what does that say about these non-trending markets? And I go back to my law of non-trending and trending markets. And a market at rest will remain at rest unless acted on by an unbalanced force. A market in motion continues in motion unless acted on by an unbalanced force. So if the market is at rest, I'm going to be looking for it to get out of unrest and to wake up that sleeping giant and to have this market move in a directional way that is going to make you and me and everyone else in the market happy, and make those people who trade against the trend fairly sad. So let's go and take a look at, take a step back, and I want to show you, remember the chart that we had of the last time the market was in a non-trending pattern. It was November of 2009 for the euro versus US dollar. If you recall from a few slides back where I showed that chart of the range of over the 21-day period, the last time the market had as low a trading range as it does today, 344 pips, was in November and December of 2009, this period exactly right here. Over this month's time period, the market non-trended. And what happened at the end of that non-trend? It started to do this, and it started to do this, and it started to do this, and it started to do this. Now, what we like to say is the past doesn't necessarily have to happen in the future, but I do know that and it may not go from 151 down to 125 over the next 4 or so months. But something's going to happen. Something's going to happen in the euro versus US dollar that's going to cause it to break out of its range. And, this is what happens when the market non-trends, when the market is at rest. The other thing that we can see here, I'll take a look at the sterling versus US dollar. Can everyone still hear me now? Because I heard a sound that I didn't like to hear. Can people hear me? Okay, you can hear me. Okay, good. So the other thing or let's take the sterling versus U.S. dollar and take a look at the last time the range was in this low 400 range, and I said that happened actually this year in March, April, sort of the beginning, actually April, May of the beginning of this year, and you can go back and look at your charts, and the range here was 397 pips. And the market at that point, when the market decided to move, it moved from 151.25 to 142.29 in less than a month. So I'm not saying again that we're going to get these types of moves, but you know what? I'm going to anticipate a trend type move in this month. In this month of September, we're going to see some sort of move one way or the other. And if we don't, then history will prove me wrong, and there will be a record period of non-trending for the financial markets, so at least over a 21-day period. So, with all that, I'm going to go back. So now that we've established this reasons, these ideas, this look at the market in a logical way to try to anticipate what it may do. It doesn't tell me one thing about whether I should go long or short the market, does it? It just tells me that the market, I'm anticipating that the market is going to move one way or the other. So if I can anticipate that, I have a better chance of catching the trend. So I'm going to pull off my PowerPoint for a second here, and then I'm going to put up my charts. And we'll start to look at the clues that the market in this non-trending period tell us about not only trading currently at the moment, because we do have to trade non-trending ranges, but also what to look for when the trend starts. What can we attach our to that will give us clues that the market is going to possibly start its trend in this direction, either up or down. So let me take off my screen here, if I could, and make sure that that's off. So the camera is off. Now I'm going to bring up my charts here. So now in my analysis, what I like to look at is 3 different time periods of charts, and in these time periods, I'm going to look for clues for the possibility of where this market might try to break out one way or the other. Now we know it's the highs and lows, the high and low of the daily chart that we can say, okay, well, if the market goes above here, it's a trend. If the market goes below here, it's a good trend. That was the low for the 21 days. This is the high for the 21 days. And so, that obviously gives us a clue. But from a trader's perspective, what I always like to do is try to get the best trade location that's going to give me the courage and keep my fear down. That's going to allow me to get in maybe a little bit early to take the clues from the market, take the clues from the charts that I look at, the tools that I use in order to determine what the bias is, and then see if we can confirm that bias by getting through levels, ultimately either moving this way or moving this way to the upside and extending this narrow trading range. So the first chart I'm going to look at, obviously, is this daily chart here, and a key level here, or 2 key levels here, that are one, a trend line that we have coming in here that comes in at this top point at 127.10, and then on the bottom we have the 100-day moving average that comes in at 126.63. Now, what can we say over the last 3 days? What has the market done at the lows here, at the 100-day moving average? And I'll zoom in here just to give you a better idea. Well, we bounced off of the 100-day moving average. We went a little bit below it, but failed and moved back above the 100-day moving average. Today, we went down and bounced off the 100-day moving average. So from a trader's perspective, this chart is giving me bullish overtures. It's telling me that the market cannot move below the 100-day moving average. That since this point right here, when the market closed above the 100-day moving average, the market has been able to close above the 100-day moving average. So over this short-term period where I'm going to focus on, that's what we're seeing. We're seeing the market a little bit of a bullish bias here. Now, on the downside of this is that we're not necessarily near, we're more closer to the low than we are to the high. But nevertheless, this is my key, what I call a borderline. This is the level that the traders have entered in to buy the market with a low risk opportunity to buy that market. Why? What's the risk? Well, you can put a 20-pip stop loss below the 100-day moving average if you're bullish. Buy the market against the 100-day moving average. Put a stop 15 or 20 pips below, and see if the market bounces. And if it does, you look like a hero. That's what traders do. They keep the risk low, and they look for these bounces off of what I call borderline levels. Now let's take a look at the euro versus the U.S. dollar on an hourly chart, and this period right here represents the 21 days of trading. 1, 2, 3, 4, 5. Yeah, I think this is the 21 days of trading here for the euro versus U.S. dollar. And let's try to analyze the market in respect to things like the moving averages. The blue line is our 100-bar moving average. We're looking at an hourly chart. And the 200-bar, that's 200, or this green line, is our 200-hour moving average. And these moving averages, what I like to do with them, or how I use them, folks, is the 100 is the trigger. So if the price is above the 100 bar moving average, that gives it a bullish bias. If the price goes below the 100 bar moving average, that gives it a bearish bias. And then the 200-hour moving average is what I call the confirming moving average. So we get through the trigger short here, we get through the confirming moving average, confirm the trend to the downside, and that keeps the bias to the downside. So what can we say about this hourly chart? Remember the daily chart, we were bouncing off the 100-day moving average. That's this blue line right here. In the hourly chart, what is in play here? What has happened over the last 3 days in the hourly chart? And if you look at this chart, we broke below the 200. We broke below the 100 on what is it? Tuesday. We broke below the 200 on Tuesday in this trend type move. When the market corrected upward, we went right to the 200, give or take. Some poor soul paid right above the 200-hour moving average, where everyone was saying sell, 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 and all the smart money was selling the market. We continued this nice trend day to the downside. Traders like trend days, right? Because they make the most amount of money on a trend day. So all our institutional traders were very happy to sell to this guy who bought above the 200-hour moving average, because they want to stay on the trend. They want to make as much as they can. Then we go into the non-trending period here. But since this break right here, what has the 200-hour acted as? The 200-hour is acted as a nice borderline to keep the market bearish bias to the downside off the hourly chart. So the daily chart is showing a little bit of a positive, albeit off the high. The hourly chart is showing a little bit of a negative. In fact, today, where did we go and stop? At the top here. We stopped at the 127. The 200-hour moving average was 127.65, and the high was 127.64. This is not by coincidence. This is what happens because I think the market watches 100 and 200 bar simple moving average. By the way, these are simple moving averages. If you put up that chart there, 200 simple close, that's how you set it on your MetaTrader. So what we're seeing here is a little bit of the negative from the euro. So it's giving us a clue that, well, if you were looking for an opportunity to sell and get a good trade location in the euro, you had that opportunity this morning against the 200-hour moving average. You could have sold near the highs right here, near the 38.2% retracement of this move down, near the 200-hour moving average. And if the market would have gone above the 200-hour moving average, you could have closed your position out of this small loss. If you sold this level right here, you're sitting in the catbird seat, because we're still looking for a trend, right? We're looking for this market to extend outside of the trading range. So from the hourly perspective, what would be the next target that we're going to have to get through? We're going to have to get through this trend line here that I've drawn in here. And although we went below it these two times right here, you see how this market rejected these lines right here? So I'm going to keep that integrity of that line here, and I'm going to use that line as the next target on the downside of the hourly. If you're able to get through this trend line here, the next target will be this low right here, where, by the way, we have other, this is another key level of support. Why is it key level of support? Well, we had a low here, we had a low here. We know it's the near the 100-day moving average, and we also know that we had a low here, we had a low here, we had a low here, and each of these times the market bounced, the market really bounced. We had a low here, and the market bounced. We had a resistance here, the market fell, and then the market went through. This is what I call a remembered line. We came down to this level right here, and the market bounced off of that level. And then when the market fell through here, and then the market fell through that level, and then the market moved above that level. That's what I call a remembered line. And so not only do we have the 100-day moving average, but we also have this key, what we call a remembered line. This is a line that the market remembers. It remembers that the market was in a free fall here, and it bounced. It remembers that the market came up to this level and moved out. It remembers that the market came down to this level and bounced. It remembers the market came down to this level and bounced and found support there. These are remembered lines. This is what the market looks at as and uses as border lines for your trading. So from the hourly chart, we're seeing a little bit more bearish bias here. We're seeing against the 200-hour moving average, we have to get through this level, we have to get through this low, and if we get through that low, it should be a move further to the downside to eventually hopefully take out this low, which is the low that we've seen over the last 21 days. Now let's go to the 5-minute chart, and we'll look at the 5-minute chart and see what clues this is telling us right now in the market. And what we can see off the 5-minute chart is that, hold on, off the 5-minute chart is we see a lot of up and down action here in the euro dollar today, signaling that the market is, well, a little bit unsure of what it wants to do. The 100 and the 200 bar moving average are converged at this point. You can still use these moving averages. You can still follow the moving averages and see what they're saying. Break below the trigger, go down to the confirming. Can't get below the confirming. Come back, can't get below the confirming. Move back above the trigger. Move below the trigger and the confirming at the same time. Trend to the downside. Fail at the lows. Why? Because it's the key low. We had the buyers come in. Move back up, break above the 200, move higher, break that. Now we're down. So it's up and down, and that's okay, folks. I mean, if you were to trade this 100 bar moving average and the 200 bar moving average and follow the clues, you could have made money here today. It's a non-trending market, but if you follow this, we come down to the 100 and we break below the 100, break below the 200. Now we're using the 200 as resistance. We have to go lower. So you can follow these tools very nicely. Where you can really follow them is something like this, where on Monday, Tuesday, the market started to move below the 100 bar moving average at this point, and we used it. We tested the 100 bar moving average here and used it to move down, and we tested it here and we used it to move down. Remember I said dealers and the big boys are going to move the market, are going to use these levels. Why? Because they're low-risk trading opportunities. And then eventually the trend ends right here, and we go up to the 200, and we break below the use the 200, come down below it, and then we'll use it to the upside, stuff like that. These things happen all the time. Why? Because people watch these 100 and 200 bar moving averages. So again, getting to the clues that the market is giving us and the opportunities intraday, we can use these moving averages, and also we can get an idea, okay, which way the bias is. So right now, folks, I got to look at the euro versus US dollar, and I got to say, all right, we failed on the top side here. We went up to this, these old highs here, and we came back down. We're back below the 100 and the 200. We are below. We came up to the 200-hour moving average. We have still some targets to get through on the downside. If we get through the 2685 level and then get to this floor, we're off and away to the downside. And that will also get us through the 100-day moving average, and move us down toward the next target, and possibly down to even like this 2432 level would be a target on the downside, 300 pips or something like that. It's not like we saw in the other ones, but that's what we're looking for, is a range extension. Range extension, and that's if we can anticipate a range extension, we have to start looking at the clues that the market's going to give us on a really micro basis, and try to see if we can parlay this into a bigger type gain for your trading. So if you're short at this point right here at the market, I know, and let's say, I would have sold it right here, but if you sold it right here, you would probably put your stop above the 100 bar moving average here at the 127.22. We want to see the price stay below, maybe above this high right here at the 26, and give it some room. And if the market is able to rotate down and move toward this trend line right here, we got to get through it, confirm the move through that trend line, and get through our lows, and then we're going to be on our way toward extending the trend. And we don't know when it's going to happen, but all we have to know is, all we have to do is follow our clues from what the market is giving us, and then we'll be on our way. So how much time do I have, Sean? You can put that in the IM, and I'll start to look at the sterling versus US dollar. Maybe about 10 minutes. About 6 minutes, I think. Well, yeah, about 12:40. So rather than answering questions right now, why don't I go into the sterling versus US dollar and take a look at that, because that is going to be another one of our currency pair. Well, we're at this narrow trading range for the sterling versus US dollar. So what can we say about the sterling versus US dollar? And we'll take a look at the same clues from our daily or hourly. All right, what we can say over this last 1, 2, 3, 4, 5, 6, 7, 8 trading days is that the market's been above and below the 200-day moving average. So the market doesn't know what it wants to do yet. It doesn't know what it wants to do, but it's going to be looking for clues, just like you and I look for clues in the market here. And what we have here is we can draw a trend line here that we broke above yesterday, but failed. And when it failed, the market started to move down, and we corrected off that high. Now this trend line here, which I put in a parallel trend line on the downside here, becomes a guardrail for us, a channel, a borderline, a level that we can perhaps get some clues from. And so from off this daily chart, we're seeing that the market is above the 200-day moving average, and we are below this trend line. But we are below this trend line at 154.62. Now the market's at 47, so we're close to it, but we're not above it. So we haven't gotten a confirmation from a move above the trend line. So that's what we can say about the sterling. And this is the 21-day range, this high right here and this low right here. So we have something to look for, either a move above here or a move below here in the sterling versus U.S. dollar. Now, if it does move above this trend line, we're going to be starting to target these levels, these highs, and ultimately, try to work our way toward the 157.08 high and work our way above that and extend the trading range. So you want to trade near these borderline levels, and if you get the movement that you expect, then you watch the market move toward your levels and hopefully extend the trading range. You have a nice gain on the trade. If the market were to go up a little and then come back down below this trend line, you get out. That's your, this is your reason to trade. And if your reason to trade is to buy against this level and it goes back below, you want to sell. And if it goes below the 200 day moving average, you want to sell, and you want to look for a break of this 38.2% retracement of this move up. That comes in at 153.21. Get below that level. Get below the low that we saw at 152.91 the other day, and we're on our way down to the bottom end of this channel and to test the 50% retracement and the 100-day moving average. That's what it's telling me. So I'm looking for the clues off the borderlines, off the 200, off the trend line here. That's going to give me an idea. Now let's look at the sterling, an hourly chart here. And what we can see here is we have this big, huge channel here that's coming in play. And this is what, 1, 2, maybe three weeks, a little less than the 21 days trading range here. But you can see we have two lines on the bottom, and we have 1, 2, 3. We broke above a little bit. I don't mind these little breaks above. I just want to get some sort of border that I can lean against, something that looks that people can see and visualize by using these trend lines, and that's what I'm seeing here. Now this chart is telling me some good news about the sterling versus U.S. dollar. One, we are above that 05 level, which is the 200-day moving average. That's a green line. This chart comes in at 154.05. Two, we're above the 100 and 200 bar moving average, which are converged here, so that's giving me a positive bias as well. So for traders who were around and paying attention to these indicators, you could have bought the market at this point right here, anticipating that we're going to have a trend at some point or another, and you're looking for the market to continue and give you confirming signals by getting through this high right here. This is remembered price. Look at the remembered price over time. We have a high here, we have a high here, we have a high here. We broke above, failed here, and then started this chart move to the downside after the failure. That's okay. Failures are good. They give me an idea to go the opposite way. But we have to get above this level right here, this remembered price, and then get above the trend line, and then we're going to start our move to the upside. That's what we have to do for the sterling versus U.S. dollar. On the downside, if this market can't get above, you can't get to this line right here, we may see a rotation back down and another test of the 100-bar moving average, move down here, in which case you want to sell the market and look for the market to move to the downside and start to test those downside levels. Now, off the 5-minute chart, if we take a look at this, it gave us this bullish bias here. At this point, move above the 100 and start to move, go to the 200, move above that. We ran into the high here, Pavlovian dog reaction. This is sell old highs here. We had a high here, high here, high here. So the market's going to sell that high because that's what it does. And now we're back at the 200. So you can see here that this market is still trying to figure out what it wants to do. But if it goes below this 200, we should see a rotation back down to the 05 level and a move to the downside. So the sterling's still trying to fight its way one way or the other, and it's still having a lot of difficulty going one way or going figuring out which way it wants to go. So that I hope what I've been able to teach you today, what I've been able to impart, as far as wisdom goes, is this idea that that the market, first of all, is in a non-trending range. It's historically in a non-trending period here, and as a result, I expect that the market will look to trend. And the other thing that I want to implore is certainly that the market is able to give traders clues as far as which way the market is leaning. And if you use those clues like moving average lines, like trend lines, like remembered lines, these aren't hard technical clues, but the market uses them to lean against and to give them ideas as far as where the market goes. And then you look for confirming moves that the market moves through key trend lines, key moving averages that will give you more confidence in the trend. Eventually, the big boys, those people who are interested in moving the market, in making money, are going to come in and they're going to push the market away from this trading range, and we're going to see the trend. And when we see the trend, I want you all to be on that trend, because you make the most amount of money trading the trends, not trading against it. So that's it. If there's any questions, I'm going to be taking questions off of the chat here. And if anyone wants a copy of this PowerPoint or want to open an account with FXDD, of course, or you are interested in my daily email video distribution list, I do 4 a day. We use the same tools, use the same ideas. This is just an extension of it. Or if you want to ask any questions or make any comments, send me an email at greg@fxdd.com. My website is forex.fxdd.com. And that's where I update my commentary. And I really appreciate everyone coming in here today. Also, in a few months' time, actually next year, I'm going to be at my first book published. It's going to be called Attacking Currency Trends, published by the financial publisher Wiley, and that's going to be coming out in the first quarter of 2011. So a lot of the ideas that I express in these webinars and seminars are what is going to be in the book. So questions. What will confirm an upward trend? Jack, let me get my charts back up. Take the camera off and bring up my charts and put the camera back on. And Jack, there's going to be for the sterling. Okay, there's going to be a few things along the way. First of all, we have to get, this is our ultimate target, to get through this 21-day high at the 157.08, and it seems like a long way off, but this range is going to be extended one way or the other, either to the upside or to the downside. If it doesn't, then we're in for a very bad year for trading. So one of the things that is going to confirm that's going to give me more confidence in the uptrend, Jack, is if the market's able to get above this trend line. And then once we get above the trend line, we're going to have other targets along the way that we're going to have to get through off this daily chart. Obviously, this high right here. We're going to have to get through this highs right here. We're going to have to get through, this ultimately the high here, 157.03. Trading and confirming or trading with a trend is about getting to levels and getting through those levels one at a time. It's not okay, we broke this trend line, we're going to 157.08. I'm going to just turn off my machine and wait for the move to come. And by what I mean by that is, especially when you get in a non-trending like this is that the market, because of the fact that it's non-trending, has a number of different hurdles that it's going to have to get through. And what you are looking for is the confirmations, not only in the daily chart. Okay, the first step, getting through this trend line. We've got to get through that borderline. I'm just doing the bullish scenario right now. Okay, the second confirmation would be going to something like the 5-minute chart, and you want to see the price remain above the 200, remain above the hour, the 100-bar moving average. And right now we're seeing that. We're seeing the ability. We move up, we come down, we test it, and it's up to the market. Does it want to push it higher? Do the big boys want to push it higher? It's probably unlikely here this afternoon. It'll probably happen during the the day, earlier morning time. But it can, but if what as a trader is that you can lean against this 200 bar, against this 100 bar moving average, have a low risk trading opportunity, and if the market does push through the upside, you're either going to lose a little or potentially make a lot, and that's what you're trying to look for, is that potentially make a lot. So you're going to look for, your confirmation is going to be stay above the 200, get above this level, get above the high for the day. If we can do that, we're on our way. And then you look at the hourly chart and you say, okay, we're looking good here, and we got to get through this high here, we got to get through this trend line, and then we're working on our way. So it's about steps along the way, and it's about finding those key borderline levels. These levels right here, where you can get the good trade location, where you can risk a move that fails. Okay, you can risk. Okay, I'm going to buy at the one when it goes above a one. I have a bullish bias. I'm going to buy when it goes above the 154.05 level because it's a 200-day moving average. I'm going to buy. I'm going to get confirmation when it goes to the 200-hour moving average, and I'm going to put my stop at 154 even, and forget about it. All right, that's my bias. I think the sterling's going up. I want to I bought it at 05, 06. I got the confirmation through the 200, and now I'm sitting in the catbird seat. I have good trade location. No one can take it away from me until it goes to 154 or below 154. And I'll risk 6 pips. I don't care if it goes up and comes all the way back down and I lose that profit opportunity. I am looking for a trend. I am looking for an extension of the most narrow trading range that we've seen since May of this year. And other than that, the most narrow trading range in 2 years' time. So that's what I'm looking for. That is what I'm building for during these times when the market doesn't trend like this. Are there any other questions out there? What can you say about 20-day simple moving average? Thank you, Joseph. What I like to do, folks, is that I like to keep a uniformity to all my charts, and so that's why I look at the 5-minute, the hourly, and the daily. Obviously, a 20-day moving average is going to be a lot faster than a 100-day moving average. Okay, but guess what's going to be fast? What I look at, the 100-bar moving average on the 5-minute chart is going to be a fast moving average, and the 100-bar moving average on the daily chart, 100-hour moving average on the hourly chart is going to be a faster moving average that I'm going to follow. So, but I keep the uniformity of all the moving averages and look at all of the clues that each of them gives and trade off of the clues from them. So, and I don't like to clutter my charts. I'm very happy with the moving averages that I use in all of them. I think they give me good buy and sell decisions when the market moves through the levels and it doesn't necessarily hang around the levels. Just watch, go, even when it fails, it fails, it comes back down, it moves. When it goes up to the 200, comes back down, moves above, boom, boom, comes back up to it, boom, boom. That's what you want to see in a moving average. If you can put up a 20-bar moving average on your chart, who was it? Who said that? Was it Joseph? If you can put a 20-bar moving average on your chart and see the market move away and use that level as a key resistance level, just like we get above the 100, we go right up to the 200, we move back below, we come up to the 100, move down, we get above it, go. If you can see that type of movement, it doesn't matter that it goes above and below these lines. What you're looking for is the movements, and then you're going to use other tools to get out of the trade. But if you can see that type of movement, folks, that's when you're going to you have a good tool to use. And they're tools, they're like going to your toolbox and you become very, if a carpenter doesn't have a hammer, he doesn't have anything. So what you have to do is make sure that your tools that you use, and the tools that I use, are trend lines, moving averages, 2 moving averages, and Fibonacci retracement levels. Those are the only tools I use, folks. And trend lines include what I call those remembered lines. So Anyway, that's it. So we are at 12:52. If there's not any more questions, I'm going to end it up here. I thank you all for coming out here today and bearing with me and the ups and downs of technology and my little cough when I get things going. But I appreciate everyone coming out. And if you want the presentation, you can. I'm sure it'll be up at FX Street. Mickey or Maud can probably share that with that idea with you. Again, if you have any questions or any comments, please send them to myself at greg@fxdd.com, and I'll be happy to help you. And if you want to sign up to my email distribution list, you can also request that through that email. If you don't like it, just send me an email. I'll take you off the list. Thank you all very much, and have a great day. Thank you, FX Street, for making this all possible.